humans. Welcome to The Frontline, a leadership and business podcast brought to you by Peregrine Corporate Services, an Isle of Man-based fiduciary provider. My name is Martin Hall, and thanks for listening. In this podcast, we chat to an array of business leaders from different sectors to learn more about them, their market, skill sets and knowledge. We hope you enjoy. Today we're joined by Mary from FIM Capital. Thanks for joining us today, Mary.
Yep, it's a pleasure to be here, Martin. Thank you.
No, pleasure. So perhaps just provide a bit of background to our listeners. Where were you brought up? Where was your early schooling?
Well, I was born and bred in Dublin, in Ireland. So I effectively grew up there until I was 13. And then my father's job took us to the Isle of Man. So I finished my schooling at King Bell's here on the island. And then I went to university in St Andrews, but decided after a couple of years there studying English literature that it wasn't quite what I wanted to do. So came back to the Isle of Man and started working in the finance sector, initially in an office role, and then a back office role, and then subsequently a front office role at Coutts, which is where I started my investment management career about 25 years ago.
Right, okay. Was that a conscious decision at that stage, or was it just the way it went?
I think it was partly the way it went. I think when I was very young, I didn't really know which direction I wanted to take with my life, to be honest with you. I was always very studious, always very conscientious about my studies, so I felt that a degree was where I was supposed to be. But I didn't, I think I, in hindsight, probably should have gone for a sort of law type degree. But I went to St Andrews, where they don't actually read law, so that wasn't very clever. No. So I decided to come back to the island, and I realised as well that I just felt that I was studying for the sake of academia rather than actually looking for a way forward in terms of a career. I wanted my independence quite badly as well. Right. I was just at that age where I wanted to get away from, being reliant on my parents and so forth. So when I came back, I did apply for a job. I went to CMI first, which I think is now part of IFGL, I think. And that was just some back office role, and I did my company and trust exams there, partly because my brother at the time was studying for his ICSA exams. And I thought, well, I'll just go down that route to start with, because it seemed like a very broad-based study set, because it included investments as well, which I quite enjoyed the investments module. So when the job at Coutts came up, I thought, well, actually, I quite enjoyed the investments module in my offshore company and trust exam. So I thought that might appeal to me. Yeah. And it has done really ever since. So it's something where you just never stop learning new things. And it's allowed me to continue with a sort of sense of academia, but also earn money at the same time and gain my independence.
I suppose it lit that fire, maybe sitting that investment exam. And I've had this conversation on this and potentially a few other the other podcasts. It's funny at that young age when either you go on work experience or you've got to make a choice to go to uni to study something that, and I only say it from my own experience, I had no idea, and probably still don't now, what I want to do. But that young age, and I guess that's the way life is, you have to potentially make decisions that about where you want your career to go. And the reality is you don't really know anything at that age, do you? No one does.
No, I think you're being asked to make decisions that are going to potentially change the rest of your life at a time in your life when you really haven't got a clue. And I have two teenage sons. Well, actually, one's just turned 21 today. And, the two of them still don't know where they want to go. And I don't want to push them down a particular route. My parents were very good to me, actually. They never forced me down any particular path. The one thing they did say is they didn't want me to be an artist, because they said they didn't want me out on the streets starving. So I was actually quite good at art at school. Right. I enjoyed painting, for example, and music, and I'm quite sort of arty that way. But they said that's just not going to be a career that's going to get you the comfort to which you've become accustomed, sort of thing.
Yeah, right, yeah.
So I said, okay, well, I get that. So
Banksy might disagree with that. I don't know.
Exactly. Well, I could have been the next David Hockney or female version thereof. Yeah. But yeah.
So you progressed. I presume did you spend some time at Coutts? learning the art?
I was at Coots sort of in the latter years of its development on the Isle of Man, unfortunately. So things were already starting to wind down by the time I got there. But it did put me on the path of taking my securities exams, because initially after my company trust exams, I started on the ACIB route. And when I joined Coots, they had a very strict policy that you had to obviously study exams that were relevant to what you were doing. Because I'd gone into investment management, they basically said CISI, which is the Chartered Institute of Securities and Investment, that I had to go down that route. So I started on my securities exam. So they put me on that path. And then I hopped around a little bit, because after Coots, I went to the first iteration of Thomas Miller Investments on the island, and I was acting more as an investment analyst rather than an investment manager. So I sort of took a step back from the front line a little bit for a short while. But they too were also winding down their operations in the Isle of Man at that time, even though they reopened at a later date. So again, I felt that things were the momentum was being lost a little bit. So I ended up my first sort of proper long-lasting role as an investment manager was really at Standard Bank Stockbrokers on the island, where I actually worked with my current colleague Paul Crocker. So the two of us, that was also actually we worked already at Coots together. So I've actually known Paul since the start of my career. So can't get rid of each other.
Yeah, following each other around.
That's right. So
to go back to those Thomas Mill days, I presume investment analysis you're looking at, you're getting under the bonnet of firms.
Actually, not so much firms, but fixed income. It was very much fixed income oriented, because I was doing a lot of analysis for the company's mutual insurance bond type portfolios, and they were largely fixed income based. So there was a small element of equities, but I think in terms of assets under management and analysis there, at the time, it was only about 5% equity, and it was 95% bonds and cash. So that probably sounds a bit boring, but actually, I quite enjoyed looking at duration risk and yield curves and credit rating changes and things like that. It was almost more of a compliance role in essence, because you're looking at the sort of default risk of bonds and that sort of thing, rather than looking under the hood of equities, which really started at Standard Bank Stockbrokers. So that was really where, because I also took on at Standard Bank more advisory clients, and that in a way is very much a two-way process, because although you're qualified to give advice to advisory clients, they're also effectively teaching you, because a lot of advisory clients have a lot of experience already in the market. A lot of them are older than me, so they had that natural legacy experience from 20 or 30 years in the market. So even though quite often advisory client portfolios are more high maintenance in the sense that there's more communication required between both parties. It's not like a discretionary mandate where you can just invest in your strategy at whatever time you want to do that. For an advisory client, if you want to buy or sell stock, you've got to ring them up and ask them, you've got to sell the stock to them. And quite often, they end up selling stocks to you too. I've been looking at this stock, what do you think of it? So you have to go away and research that stock, and part of you is thinking, well, it's not part of our core portfolio, but then you look at it and think, actually, it's really good stock, this. I like this. And, it ticks all the right boxes or whatever. So almost advisory portfolio management, even though it's more difficult to manage in some respects, it's actually more rewarding. So I did quite a bit of that at Standard Bank. I also worked with a lot of fiduciaries as well. So that's a slightly different approach to working with private clients, because you're working with investment intermediaries effectively, and people who understand your market perhaps a little bit better than some private clients who give you discretionary mandate, don't really involve themselves in investment. So I had a lot of fiduciary clients as well.
I guess you need a very open mind, and certainly when you talk about advisory there, and you're dealing with clients who perhaps have strong opinions about where they want to go, and being able to communicate with them, or certainly if you feel they're perhaps going down I use the word a path or an investment path, they're perhaps blinded by some advice that someone's given them. Well, not advice, but a friend of a friend said this investment's the greatest thing since sliced bread, and you have to convince them otherwise. Communication must be so important. Talking off the ledge, maybe at times even.
Yes, it is sometimes. I mean, it definitely. I won't cite specific examples, but yes. I mean, usually what it is I know I've had a number of advisory clients over the years who are extremely experienced people, but also some advisory clients that are not experienced in the reason they want the advisory mandate because they want to be handheld through the process. But then, as you say, out of the blue, they might come up with something that their hairdresser recommended to them, or a taxi driver or friend in the pub. And invariably, it'll be some small cap mining stock with absolutely no cash flow, no earnings, and one hope in some dusty little bowl somewhere in Uganda. Yeah. And you're going, okay, right, let's have a think about this, you know. And at the end of the day, it comes down to the due diligence that you do. What I tend to do is I would say to those people, well, I'll look into it for you and see what I find. And then I will put it down, usually in writing, because it's better that way anyway, in email or whatever. And I'll say, you know, these are the pros of the situation, these are the cons. And quite often, you know, the cons would outweigh the pros, but I'd make it very clear what those were. And then, you know, we'd have then another discussion on the telephone. The client would either say, I still want to go for it, just, you know, and then what I would do if they still want to go for it, I would say, well, I'll tell you what, we'll put like, you know, 2% in there, or we'll put 1.5%. I'll try and limit the potential for that volatility and that decision to go wrong. Of course, it could go very right, in which case I'll say, well, why didn't I invest 10% in my portfolio in it? But that's the benefit of hindsight. And invariably over the years, the decision has usually been right to limit the speculative buys in portfolios. But, you know, it does happen the other way around as well, Martin. I mean, when I was at one of my other positions at House Trust, which is a company I worked for 3 years before I came to FIM Capital. I worked with an advisory client who was very senior to me in years and very experienced. And during the financial crisis, I was worried that one of his clients' bonds was going to go into default. I think it was worth about 50% of face value. Mm-hmm. And I thought, God, this is not looking good. So he basically said to me, well, do you think that one of the biggest banks in America is actually going to go into default? And I said, well, Lehman Brothers went into default, but then we sort of compared the pros and cons of this bank versus Lehman Brothers, and we realised in the end that, you know, it was very unlikely that unless the world was coming to an end, this bank wouldn't be bailed out, and bondholders wouldn't be saved. So we held on to it, and then about 10 years ago, it matured at par. So it basically, it was fine. So anytime I speak to, I still have this client in my books, by the way, and I speak to this client, and have these moments like in COVID where we sort of wonder what on earth is going on. We wonder if companies will survive and how they'll survive. And we generally don't invest in companies that can't survive big hits anyway. But there's always one or two where you're a little bit cautious. And over the years, it's been a case of, you know, do we or don't we? Do we sell? Do we hold? Do we buy some more? And when if I get into a little bit of a panic mode, he'll just turn around to me and say, he says, "Is this one of your Morgan Stanley moments?" You know, which is the big US bank. Yeah. You know, and I said, "Well, it could be," but you know, it's that two-way learning process, and it's a great relationship to have, especially if you hang on to that relationship, as I have with this particular client for 15 odd years. So it's advisory is probably more rewarding than discretionary, but discretionary is easier to deal with from an administration perspective.
Yeah. There's kind of three things in there that you mentioned, and that ties into a question I wanted to ask around. So whenever I chat to in the investment arena, I'm always interested in people's mindset in 2008 when we felt the world was ending, certainly when it came to investments, and perhaps we'll come on to that question, and then that ties into like now with COVID, and there's this not similar reaction, that's maybe not the right term, but there's so much unknown and so much concern. Yet when you look back now through time, and again, you mentioned hindsight being the third thing, was they're probably blips, really. The reality in long perspective terms of things, they're just blips, aren't they? But in the middle of the chaos, it just feels massive. So maybe to go back to that 2008, where were you working? What was it like at that time in that arena?
2008, I was working at House Trust in Castletown. I was the only qualified investment manager on my team, so I didn't even have an investment team to talk to. I had my fellow directors and the trust and company side of the business, and we did discuss a number of issues at the time about what was going on. But ultimately, I was effectively making investment decisions on my own, which was great.
No pressure.
But no pressure, no pressure. But no, it was interesting, and in a way, it sounds a bit precarious, but because I was on my own, I could make decisions very quickly if I needed to. I had, again, these advisory clients, some of whom had seen crashes before and understood how the market works under those sort of stresses, who also were a help to me to some extent, as well as me being a help to them by doing all the research and making sure that I've covered all my bases. The key things in 2008 really were initially getting the Fed and the other central banks behind the market. Bailing out the banks was really the turning point for that crisis, because it really started with Bear Stearns going under, and then obviously Lehman Brothers filed for Chapter 11, and I think it was October. I remember hearing it on the radio, and I nearly drove my car off the road. I swear to God, I knew that day was going to be a very long day in the office for me, because that was really the start of the big panic stage of it. And the TARP, this Troubled Assets Relief Program that the US Senate eventually agreed on, was quite slow in coming. The market was falling by 700 or 800 points, the Dow, and I just thought, for God's sake, get on with it. You need to save the economy. But a number of things I suppose I learned from 2008. Well, what I actually did at the time was there was an option then to switch some of your long-term profits and equity into corporate bonds, where you could use that as a buffer against volatility. But corporate bonds at the time were yielding 3%, 4%, or 5%. So you could get a decent return on corporate bond issues, or even US Treasuries were, I think, about 2 to 3%. So you could get a decent coupon. The difference between then and now is that interest rates are near zero or negative. Bond yields are negative. I mean, up to 5-year UK gilts are actually in negative yielding territory now. There is nowhere else to go other than sticking with your high quality equity investments, which is what we've largely done. There's no point going to cash, really. Another thing we learned in 2008 was that cash is not always the safest asset. I think the biggest call that I had to make, really, during that time, was when clients were ringing me up saying, what the heck do I do with my cash? They didn't really care about their equities because they knew they hadn't realized any gains or losses. They were just allowing that to sort of ping pong around. They were more concerned about what to do with their deposits. And of course, we had the Singer and Friedlander collapse in the Isle of Man at that time. So there were some decisions to be made surrounding client assets that were actually outside my investment mandate, but were within the mandate of our company, because I was a director of a trust company as well as the investment director. So there were decisions to be made on deposits for Singer and Friedlander, which we did actually get out literally 3 days before they went into liquidation or closed down. And so those decisions had to be made very quickly. There were also weird things like ETFs that were sponsored by AIG, which obviously collapsed or fell apart during the crisis. Because they were no longer the primary sponsor of the ETF. The ETF went into suspension. So I had 2 million of clients' assets in suspension for 5 days, and I nearly didn't sleep a wink, basically. But that was just a sponsorship issue. It wasn't a solvency issue. So after 5 days, they found a new sponsor and they listed again, and everything was fine. But there were all sorts of hammer blows that could fall. And I was desperately trying to avoid anything that could be problematic within that sphere.
It's a great learning as much as in the middle of it. It's chaos isn't the right word, but stress and pressure.
Yeah,
the learning curve is something to cherish, I guess, as difficult as the time was. I'm sure. I know where I worked at the time, a trust company, and we had a lot of cash balances. You mentioned cash there, and that was our bank's going to be around. We need to split this cash out between more banks in case some of these banks go down.
Yeah, and it's interesting how easily people forget that, and they say still that cash is the safest asset when actually, excuse me, it really isn't necessarily.
It wouldn't be at the moment you had euros, because they're just you're not negative interest on them, aren't you? You're just losing money.
And I think we could see negative interest in the UK as well. We've already got senior economists at the Bank of England discussing that possibility. So
the interesting, when you were chatting there about the banking crisis, it reminds me actually, and it doesn't paint the world's greatest picture of the financial sector, but there's a documentary, I've seen it on YouTube, it's called 98% Owned, and it talks through the financial crisis and some of the situations there about the bailing or not bailing out of certain institutions, where I think they bailed out AIG, they did bail out them, but they didn't bail out Lehman and let Lehman go. And that whole process where you mentioned as well, took a while to go through Senate, and they talk about why it took so long to get through that process, and the decisions that had to be made were just unbelievable.
Unbelievable. Yeah. But having said that, with the COVID situation, the QE that's now been enacted by central banks and governments is far greater by a factor of God knows how many. I mean, it's just magnitude is just enormous, effectively.
Right.
But it's been agreed and enacted a lot quicker, and I think ultimately because it's not the banking sector this time. It's perceived as a humanitarian crisis, effectively. So although my view is it ultimately does bail out the banks, because things won't go into default if you provide enough, QE and support and ramp interest rates down to near zero.
Yeah.
That does protect the banking sector, which ultimately they haven't got much choice, because it's the financial infrastructure of the world. You still need the banks to function in a functioning economy. So, but it is a humanitarian crisis. So the QE that has been passed into law effectively and the fiscal stimulus has been much quicker to arrive than it did in 2008. So, and it's also been unanimous across the globe pretty much. Europe was very slow to react in 2008 by contrast.
And do you think that's do you think the reason for that is because they've learned from 08, or because this is more, because the nature of this is more, about a pandemic rather than, what many maybe perceive as poor financial infrastructure that could potentially cause the first? And
I think it is the latter. Yes, yeah. I think it's the fact that it is a pandemic, and it's much more easy for politicians effectively to justify throwing loads of money at a pandemic than throwing money at the banking sector. Plus, the financial sector generally is better capitalized, maybe not as much in Europe, but certainly in the US. The capital buffers are much stronger than they were in 2008. So when banks are stress tested, although in the US they did say we don't want you to pay your dividends this year, they did suggest that their tier 1 capital, their buffer capital, would still be at a reasonable level, even if we saw, countrywide defaults on various loans. So it is definitely, and I think that they probably have learned from history. Also, it depends on the politics at play as well. Europe always tends to be a bit slower. Even in this crisis, Europe was a bit slower to act because countries were kind of vying with each other as to what kind of relief they should provide. And eventually, they did step up to the plate and said, look, we've got to do something because, the US and UK have already acted, but they have a much bigger, confederation of states in which to try and reach consensus. It's a bit more difficult for them. Sorry.
Yeah, I was going to kind of move into the still on that same general subject, but first of all, I suppose to set the scene a bit, when you look at risk appetite, and I guess a firm will have a risk appetite. When you look at your own views on risk appetite, are you a conservative person by nature, or not, or where would you say you lie? Which leads into a question I have.
I think as a person, I am quite conservative. I always try to look several years ahead of myself, which obviously the best laid plans for mice and men don't always come to fruition, but I am generally conservative. The only thing I would say is that I do believe in the cult of equity. I understand how capitalism is supposed to work, which is effectively, you invest your money at risk, you put your capital at risk in order to provide capital for a company in order for it to do business. And the reward you get is supposed to be a dividend or capital growth. at the end of the day. Now, obviously, this year we've seen cancellation of a lot of UK dividends, and I suppose the socialist view of that would be that, well, of course, that's understandable because a lot of people are suffering and companies have to keep cash on their balance sheets. But then we have seen some companies cancelling dividends where actually they have plenty of money to pay. We've actually seen a company this morning reinstating its cancelled dividends because it realised actually we've kind of overreacted. We've got plenty of cash on the balance sheets. So that's good. But, I think people need to recognise that pensioners also rely on dividends as well. So, I don't like to come across as a heartless capitalist or anything like that, but I am a capitalist, and I will say that even to my most left-wing friends. I'm probably slightly right-wing. I'm definitely a capitalist, but I am conservative in the fact that I like to buy companies where I can see what they do, I can see where their earnings are coming from, I can see how well or how badly companies manage their cash flow. And I prefer companies that will pay you a dividend ultimately, because I think if you have a good dividend track record, it's something you'd like to hang on to. Now, that's probably less the case this year, but I think this year should be seen out of context for the rest of time, effectively, because this is very unusual. And I do think that a company that generally prides itself on a progressive dividend policy is a company that will look after its cash flow. I also increasingly like to see companies that are good stewards of their businesses, and also companies that make a strong impact in their community and treat their shareholders and their employees and their customers the right way. And I don't like it when you hear little snippets of news about, say, Tesco squeezing its wholesalers for extra margin or whatever. These little penny pinching things, or the Wells Fargo issue where they created all these fake accounts and fired a load of their staff, even though management knew about it. I thought
tell them to do it.
And that was poor. So we have actually sold stocks on the back of some of these things in the past, where it hasn't necessarily been a balance sheet issue. It's been a sort of ESG concern, if you like. Even though I don't really like the ESG tag, but I think it is a social concern. So my way of saying is I think I am conservative, but I do believe in culture of equity. And I'd like to see an element of social capitalism creeping into things. It sounds like a contradiction in terms, effectively. But I think if corporations continue down the path they're already taking, and show more consideration towards societies in which they operate, and their own staff, and their customers, and their shareholders, but it has to be more even. I think there has been too much emphasis on the shareholder, perhaps, and not enough on the rest of the equation. And again, that's arguing against my own profession in a way, because I want to maximise the return for the shareholder at the end of the day.
I asked the sort of that question around the risk appetite, because at the moment I'm listening to an audio book that someone else recommended to me. It's a psychology book, Thinking Fast, Thinking Slow.
Oh yes, Daniel Kahneman.
And in that, it's just a snippet of that stuck with me. And he was talking about a study they did which isn't obviously not related to investment, around judges looking at parole, and their decision-making process changed during the course of a day. So as they got hungrier, their decision-making process changed around whether and parole was granted less towards lunchtime, and straight after lunch, the parole grants were higher. And this was consistent, blind study that was done. So clearly there's a psychological process there going on subconsciously, because of interior workings. And I just wonder, in regard to investments, if that's, again, is that something, that's like psychology side of things, something that's factored into decision making, that not necessarily what time of day you're doing it, is it just before or after lunch, but is that a thought process that's in the investment world when as investment managers you're making those decisions?
I think the decisions are very much based on ultimately our client's psychology rather than ours. Really, a client can come to you having ticked the I want maximum growth but minimum risk box, and that's when you really need to talk to them and say, well, what do you really want? What are you really looking for out of your investment? And quite often you learn more about what a client's risk profile is from what they tell you about their life rather than what they tell you about their investments. how they've made their own decisions in life, and you could tell from that whether they're risk averse or risk tolerant. And yes, there is an element. I think from our perspective as investment managers, I think there's an age thing as well. I don't like to be ageist, but we have this conversation in the office all the time about new economy stocks versus old economy stocks, and we have young members of the team who are pushing the Amazons and the Microsofts and the IBMs and all the FANGs and all the rest of it, and then you have the rest of us who are kind of being bitten by the dot-com bubble bursting in the early 2000s. So there's a generational caution, if you like, from our generation to the next generation who didn't experience that. But those two times were actually very different as well, because valuations in 2000 were largely based on the promises of earnings to come rather than actually technology being part of infrastructure, which has become a real issue under COVID in the lockdown scenario. And we can see, and if your eyes weren't open before, they certainly should be open now to the fact that a lot of IT, integrated IT rather than the consumer stuff, the iPhones and things, the integrated IT has become new infrastructure of the world. And this is something that older investment managers like myself have taken some time to get it on board with in terms of the risk tolerance, because I always think, well, technology, biotech, very risky. I only want 2% of my portfolio in that, but actually technology is now about 20% of the global index. And I think, maybe that's a real underrepresentation. But in recent years, we have been increasing our technology exposure, perhaps through gritted teeth in some cases, because we've been that bird once bitten, twice shy.
Yeah, of course.
Whereas, so the younger generation haven't been through that, but so sorry.
And on your committee, have you got then? I presume you've got a blend to bring that balanced argument.
Definitely, yeah. I mean, we have obviously Russell Collister is our CIO, and he has said, especially more recently, I want the younger members of staff, the younger members of the investment committee to start making, bringing some ideas to the table about their world, because their world is different from ours. I see this with my teenage children the whole time. They're on Instagram, Snapchat, Twitter, blah, blah, blah. They spend their whole lives online, if it's streaming video games or FIFA football or whatever it happens to be, or, one of them reads books online, it's everything is online, it's on demand, there's even a language that they use which is different from the So every generation.
You need to listen to the podcast I've just recorded with the gentleman I was saying before on air, and he's in the esports arena, and like you say, it's an area I don't know a lot about. I know a little bit more now, but just another world in many ways, isn't it? And
it is.
I guess as investment people, and in all industries, just as much as we're in the fiduciary space, you got to move with the times, whether that's tech or not.
Yeah. So, I was just going to say, I think you need that blend of the generations on an investment committee ultimately, because it's all very well to have all the people who think the same as you, because you're all self-affirming each other's ideas the whole time. You need people to challenge that.
Oh, yeah. I'd say that's almost more important than having people just nod and going, great.
Yeah, great. Definitely. Yeah, definitely have that.
So when you're looking particularly in the investment space, and I use the word tech in the concept of technical information about investments rather than technical investments, if that makes sense, technology investments. Do you find that a challenge with clients? Because I guess clients have a broad range from just no understanding of what they're investing in, and you kind of just walk into and the language needs to be basics, I guess, whereby others might be, like you say, very experienced and therefore almost challenging you back about what you're talking about.
I find it probably easier to talk to the people who have a high level of financial technical knowledge, because then I can speak on the same level as them. And as you say, sometimes if it's an advisory client, there's obviously things they will know that I don't know, especially if they're, sometimes people want to invest in stocks that are within their own profession. So they will obviously know more about those stocks than I will, because they're almost, involved, and not obviously to the point where you're talking insider trading or anything like that.
I know what you mean. Yeah,
you know what I mean? So they operate
yeah.
within those, and they can see for their own eyes what looks good in their own industry. So I wouldn't even presume to try and meet that level of technical expertise, but we can talk on a level when it comes to the jargon, if you like,
Yeah,
of the
jargon.
investment.
Yeah.
For other clients, it is, I think ultimately for those clients who are less experienced, it's you yourself have to know everything there is to know about the market in order to be able to talk about it simply. So you have to understand what you're talking about completely in order to simplify it. And I think that's a very key issue. And also, we don't like to invest in things that, you know, where we ourselves might have questions, i.e., you know, a multi-hedge fund of funds where it has multiple strategies, and some of which we're kind of familiar with, some of which are a bit esoteric. We don't like investing in those sort of things because we can't fully explain them to our clients. We can't turn around to our discretionary, you know, private client, elderly client, for example, and say, well, we invest in this hedge fund, it seems to do the right thing, but we don't quite know what's you know, that just doesn't happen. Basically, it has to be something we can explain in simple terms to everybody if necessary. So.
Of course. One of the other things we touch on in the podcast with other guests is just leadership in general and your own skills in regard to that, or people learn. I mean, did you, is that something just through your career that you've just had a natural ability to do, or you've learned from others, and if you have mentors that have helped you through that?
That's a good question. I mean, I suppose it has been very much an organic process, to be honest. I haven't been on any special training for leadership of any kind. And it's mainly, in my case, it's not really about, it hasn't been entirely about leading a team. It's been being part of a team, and information sharing being the most important thing. Communication is key, ultimately. But for me, I suppose it's more about guiding clients rather than, and also guiding younger members of staff, because, you know, we've taken on three relatively young members of staff in the last 8 or 9 years in the firm. In fact, four altogether, who are all budding or young investment managers. So, you know, it's easy for me to just stay in my little bubble and lead, you know, my clients into the right investments, but I also need to lead my younger colleagues into that as well. And I think there's a very good culture, especially at FIM, where, you know, everyone has the right to ask questions, to challenge. I could be having a conversation with Paul Crocker, who's my fellow investment director, and in the middle of it, one of our younger members of the team, like Adam, will speak up and say, "Oh, I heard something the other day about that stock, but I didn't really understand what they were talking about. Can you explain it to me?" Yeah. And then, you know, it's more about just communicating, which is why under COVID, for example, it's very difficult to lead the younger members of staff. So, you know, when we talked about working from home and things like that, we said, well, for those sort of staff members, it wouldn't work because our industry is very much one of debate and discussion and involvement of those younger members of staff. So they need that guidance. But in terms of mentors, sorry, you were asking, I mean, I suppose, I mean, Paul Crocker was a mentor initially because, you know, he was a senior manager when I was just coming into my role as an investment manager at Coutts 25 years ago. And I mean, for what he was teaching me was really about communication then as well, you know, and being honest with your clients. And when you don't know the answer to a question, I remember him saying, if you don't know the answer to a question, it still applies today to some extent. Don't pretend that you know the answer. Don't waffle. Don't bluff. Don't sort of try to be clever. Go away and say, look, I don't know the answer, but I'll find out for you, and that sort of thing. So there's quite a few tips over the years.
Yeah, I think that's if anybody ever asked me for advice, that's the big thing as a youngster who got into, you know, just started working in government at 17 and not a clue about anything and no real knowledge, was in many ways being dumb. It kind of, you know, that you just ask questions, so it becomes instant. But that's what I always say to staff that start now, just senior or not, just ask. You're far better asking than either not saying anything or doing something wrong. Because you feel worse for, not that we'd make you feel worse, but you naturally, if you don't do something right, you feel bad about it. So yeah, just ask.
There is a bit of a line I noticed when that's strong. So when I joined FIM Capital as a senior investment manager, and I was promoted to the board in 2016. And I noticed that, but from one day to the next, people then sort of were a little bit more distant from me because I was then on the board of directors. And that does make a difference. I knew from a previous role as investment director at Lord House that is what happens, although that's a much smaller company. But having said that, people have still said to me in my role here that I'm very approachable and they feel like they can talk to me if they need to. And people do talk to me, especially over lockdown. There was a lot of extra communication going on, obviously, with staff working from home. And sometimes it was just a case of sending the odd, Facebook message to the odd member of staff who sounded like they could do a little bit of cheering up, and just say, we are behind you. The board of directors is behind you all. Don't feel as though you're on your own there in your house in Ramsey or wherever.
Yeah, and I think that's a daily challenge, isn't it? I mean, again, you work in places where there's this open door policy, but I don't really like that term because your door can be open, but still someone can be scared to walk through it and talk to you. So it's being able to create that environment where they either can walk through the door or up to your desk and have a conversation.
I think also, and I don't want to sort of turn this into a male-female thing, but I do find that the women in the office will tend to come to me because I'm the woman investment director. So maybe a percent is slightly, I don't know, a more sympathetic ear perhaps, I don't know, but I mean, all the directors in the office are very approachable, but I think they sort of gravitate to me because I'm one of them.
No, I understand. And just to talk a little bit about FIM, you've got Manx-based firm, 4 billion under management.
Well, that's under administration. Under management we have 750 million. At the moment. When I joined the firm in 2010, we only had about 200 million. So it's grown a lot during that time. I think we had about 20 odd staff. We're now nearly up to 40 staff. Obviously, we have the fund administration business. So I mentioned the funds under administration, 4 billion. And then we have the investment management side. And I would say we have a team of 6 to 7 investment managers, various stages. We have 4 fully qualified and another 3 on their way to being qualified, the younger members of staff there. And I mean, obviously, we were founded in, Russell will probably tell me off if I get this wrong, but it was 2005, I think we were founded in, as part of the IOMA group. And then in 2015, we went through the MBO to separate ourselves out and become an independent entity. Business is owned by its directors, effectively. So
very much managed, owned from the island.
Very much, completely. Yes, yeah.
Yeah, right. Okay.
We moved into Athol Street literally a week before shutdown. So.
Oh, right. Okay. It's interesting there, the 40 staff comment, 'cause it got me thinking. I've worked in a couple of firms now where they've grown, and I that's the number I've always used, where I always feel or certainly from my own experience, businesses, when they're tipping into that number, the staff, you always want to create that team environment. You want to sort of, certainly as a leader and director, you want to be close to all your staff. But I always find just you getting over that number, you start to just because of the size of the business. Is that something that you guys are conscious of as you do grow? You don't lose that. It's a challenge, I think, for sure.
It is, and I think because when you're a smaller firm, and I know having worked with a few smaller firms, you are effectively the jack of all trades. You're doing everything. At one point I was even posting my own letters. It's sort of now, obviously, jobs become more compartmentalised, I think, as your firm gets bigger and bigger. But we don't want to lose that ability for staff to communicate with the board of directors or senior management, or senior management communicate with us. We have made a couple of internal changes more recently, where we now have an office manager who, where we didn't before, who will take on a lot of these sort of internal management roles, where effectively I think previously it was handled by the CEO. The CEO is also our finance director.
And trying to drive the business forward.
So we're effectively compartmentalising splitting out roles a little bit more in order for that, so that we can still see that flow of feedback and information coming back through the company. So, but yeah, you have to admit that culture in an office is going to change as the number of staff get bigger and bigger. I'm friends with a number of people in the board of directors of companies on the island that have 600-700 members of staff, and their approach again is completely different to ours, but it has to be, because they have a much bigger entity. But the one thing we don't want to lose is the sort of corporate culture that we have here, because I noticed when everyone came back to work after lockdown, one of the things a lot of the staff said to me was, I wanted to come back to work because I enjoyed working here. And it wasn't just because I was a director and they were sort of, it's because they genuinely felt that they wanted to come back because they missed their friends, they missed their, we call ourselves Finsters, the Fin family, so it is nice at the moment, and that culture might dissipate a little bit because of if we grow, but we're not really in the business of growing just for the sake of growing, so we're quite happy to be stuck at 40 staff for as long as we need to, but we'd only hire staff if we suddenly get a big influx of business and we need more people.
It's interesting actually to go back on that kind of point around staff coming back in and the challenge of working from home, because certainly at Peregrine it was similar. When we were back in the office, it was very much the guys are happy to be back. The novelty wore off fairly quickly working from home, but I think the big thing as an observer will be, I'd like to think communication was good, but for the younger members of staff where there's debate going on in the office constantly, I'm sure it's the same whether it's around investments, we're talking about fiduciary problems, issues, solutions, that when people are chatting, you pick up so much knowledge and information from listening to other conversations, and you do lose that working remotely, because you can have conversations, but you don't overhear the other conversations, and that's the thing that I think people would desperately miss.
No, I agree. Absolutely, no, absolutely agree. I mean, even at my level, sometimes I hear conversations and I think, I didn't know that. So everyone can pick up bits of conversations from people around them, and it's also with the young members of staff. We would phone them and we'd regularly contact them via Zoom and stuff. But it's not the same as that instantaneous.
No, absolutely. And Mary, if people want to reach out to you, is that LinkedIn the best way to do that?
Well, I do have a LinkedIn profile, either that way or via my email, or I do have Facebook, but I don't really use that for business. So it's either my email address is on our website as well. Okay. So all the board of directors' email addresses and telephone numbers are on our website to get in contact.
So for the listeners there, in the footnotes, we'll put down, if Mary doesn't mind, the email address and obviously a link down to their website. And certainly if you're looking for investment services, very Manx business as well, with Manx strong Manx roots as well. So get in touch with them over there. Thanks for joining me today, Mary. It's been really interesting digging into yourself and your risk mindset as well as the businesses.
That's a pleasure. Thanks, Martin. Enjoyed it. Thank you.
Thank you for listening, everyone.